The global economy moves in cycles, but sometimes the warning signs of a major market crash start appearing long before it happens. In 2026, economists and investors are closely watching rising debt levels, unstable stock valuations, and growing geopolitical tensions. History has shown that crashes rarely come out of nowhere. They build slowly beneath the surface. So the question is, are we seeing the early signals of another global market downturn? In this video, we'll break down the key warning signs experts are watching and what they could mean for the world economy. Today, we will talk about the warning signs of a global market crash in 2026. So before we start, make sure to hit the like button and subscribe to my channel. 1. Introduction. Why experts are watching the global economy closely. The possibility of a global market crash in 2026 has become a growing topic of discussion among economists, investors, and financial institutions worldwide. Financial markets have always operated in cycles of growth, correction, and recovery, but certain periods carry greater risks due to underlying economic imbalances. A market crash rarely occurs without warning. Instead, it usually develops after a series of signals that indicate stress in the global financial system. These signals can include excessive stock market valuations, rising debt levels, tightening monetary policies, geopolitical instability, slowing economic growth, and changes in investor behavior. In 2026, analysts are paying close attention to these indicators because many of them appear simultaneously across multiple regions of the world. Globalization has also made economies more interconnected than ever before, meaning that a financial shock in one major economy can quickly spread to others. Because of this interconnected structure, financial experts constantly monitor economic indicators to identify whether the world economy may be approaching a period of significant instability. 2. Overvalued stock markets and the risk of asset bubbles. One of the clearest warning signs of a potential global market crash is the presence of overvalued stock markets. Overvaluation occurs when stock prices rise much faster than the actual earnings and productivity of companies. During periods of strong investor optimism, many investors buy stocks based on expectations of future growth rather than current financial performance. This behavior can push market prices far beyond their fundamental value, creating what economists refer to as an asset bubble. When these bubbles grow large enough, even a small negative event, such as disappointing earnings reports or economic data, can trigger a sharp market correction. In recent years, several major stock markets have experienced rapid growth fueled by technology companies, artificial intelligence investments, and global liquidity. While innovation can drive real economic value, excessive speculation can also inflate prices. Indicators such as the price-to-earnings ratio and the cyclically adjusted price-to-earnings ratio have reached historically high levels in some markets, raising concerns that stocks may be overpriced. If investors begin to lose confidence in future growth, the rapid selling of overvalued assets could trigger a broader financial downturn. 3. Rising global debt and financial system vulnerabilities. Another major warning sign for a potential market crash in 2026 is the unprecedented level of global debt. Over the past decade, governments, corporations, and households have borrowed heavily to support economic growth, invest in infrastructure, and recover from economic disruptions such as the COVID-19 pandemic. While borrowing can stimulate economic activity in the short term, excessive debt creates long-term vulnerabilities within the financial system. When debt levels rise faster than economic growth, borrowers may struggle to repay loans, especially if interest rates increase. Higher interest rates raise the cost of servicing debt, which can place pressure on companies and governments with large financial obligations. Corporate debt has expanded significantly in many sectors, particularly in industries that rely heavily on financing such as real estate, technology startups, and energy infrastructure. If economic conditions weaken or credit becomes more expensive, some highly leveraged companies could face financial distress or bankruptcy. This can trigger losses for banks and investors, potentially spreading financial instability throughout the global economy. Historically, excessive debt has played a major role in many financial crises, making it one of the most closely monitored warning signs in modern financial markets. 4. Interest rates, monetary policy, and liquidity tightening. Central banks play a critical role in shaping financial market conditions through monetary policy. Over the past several years, many central banks lowered interest rates and introduced large stimulus programs to support economic growth. These policies injected massive amounts of liquidity into global financial markets, making borrowing cheaper and encouraging investment in stocks, real estate, and other assets. However, when inflation begins to rise, central banks often respond by increasing interest rates and reducing monetary stimulus. While these actions are intended to stabilize prices, they can also slow economic activity and reduce investment. In 2026, several central banks are carefully balancing inflation control with economic stability. Higher interest rates increase borrowing costs for businesses and consumers, which can reduce spending, investment, and economic growth. 5. Weakening labor markets and declining consumer confidence. The health of the labor market is another important factor that can signal potential economic trouble. A strong labor market generally supports economic growth because employed workers earn income and spend money on goods and services. However, when businesses anticipate slower growth or declining profits, they may begin reducing hiring or laying off workers. Rising unemployment can create a negative cycle within the economy. Unemployed workers spend less money, which reduces demand for products and services, causing companies to cut costs even further. In recent years, the global labor market has experienced rapid changes driven by technological advancements and automation. The increasing use of artificial intelligence and machine learning systems is transforming industries such as finance, manufacturing, transportation, and customer service. While these technologies can improve productivity, they may also disrupt employment in certain sectors. 6. Geopolitical conflicts and global economic uncertainty. Geopolitical tensions are another key factor that can trigger or worsen financial market crashes. Political conflicts, trade disputes, sanctions, and military confrontations can disrupt global trade, increase commodity prices, and weaken investor confidence. In a highly interconnected global economy, geopolitical instability in one region can quickly affect financial markets worldwide. For example, conflicts involving major energy-producing regions can cause oil and gas prices to rise sharply. Higher energy costs increase transportation and production expenses for businesses, which can lead to higher consumer prices and reduced economic activity. Trade tensions between large economies can also create uncertainty for international businesses and supply chains. 7. Slowing global economic growth and structural challenges. Another warning sign of a potential market crash is a slowdown in global economic growth. Major economies such as the United States, China, and the European Union play crucial roles in driving global trade, manufacturing, and investment. When growth slows in one of these major economies, the effects can ripple across the entire global financial system. Several structural challenges are currently affecting global economic growth. Aging populations in many developed countries are reducing the size of the workforce, which can limit productivity and economic expansion. Additionally, supply chain disruptions and rising production costs have created challenges for manufacturers worldwide. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.